Much for that. We also have Deepak Shenoy, the founder at Capital Mind, joining us on the show. Deepak, hi, good afternoon. Good to be speaking with you. Before anything else, tell us what transpired in that meeting with the finance minister. I understand you were part of that meeting where the finance minister met the FinTech's. What really came out of it? Was Paytm top of heap?
No, we were actually more about the problems faced by the fintech industry in general, from a perspective of what could be done to improve the situation. Some of them involve, a deeper consultation with the RBI. Some of them are issues around how the taxation laws are created. Some of them were ideas about new products. I think the idea here was to an open communication on what we can do as a country itself to kind of foster more fintechs to kind of help in the progression of on the financial side of things, include in terms of inclusion, in terms of maybe some of the regulatory bodies are or maybe the enforcement is action is perhaps needs more context around how certain technology elements operate more than the issues. Of course, there's no questions about any, any factor that says, give us leeway because you're fintechs or anything like that, but more like fintechs pose like a different challenge or have different challenges. And sometimes the traditional, human-led, say, versus tech-led architectures, may not appreciate the scale and the change of some of these things. So the older laws which kind of exist need to be addressed. But it was very progressive in the sense of
Deepak, pardon my curiosity. Deepak, pardon my curiosity, but how come you're spending so much time on this issue of fintechs these days, writing about it, expressing your mind, spending time with the founders, as much as accompanying them to that meet? Do you have reasonable exposure towards fintech, being a thoroughbred capital market guy, the listed space, or are you converting your company gradually to fintech? What's the secret here?
Yeah, we are a fintech. We use a lot of technology in everything we do. We have technology-based execution of our strategies. We have technology-based investing technology itself, which discovers stocks in the first place. So we use a lot of that. We're using a lot of AI and ML to understand the behavior of stocks, the behavior of press releases, the behavior of annual reports, and therefore I think we also qualify as one. Though of course this was more, other regulators. There was not so much SEBI in the picture and all that. But I think in general we are appreciative of the challenges that fintechs face in general. And this is a conversation with the government. In fact, the government itself is saying, why aren't you talking to us? Why do you guys only talk on Twitter? Talk to us and we'll help you come up with solutions. सिर्फ ट्विटर पे rant करोगे तो फिर क्या होगा? So it makes complete sense to me. I think not that I'll stop ranting on Twitter, but constructive dialogue is always useful.
What you're saying, you haven't stopped ranting on Twitter because that is one of those mediums, right?
It's a free world out there.
Absolutely, and free speech is what is the benchmark of Indian democracy, so you can't let that go. But okay, let's shift focus and talk about markets as well. Deepak, we're all wondering and thinking what's going to happen with the hospital space. Regulation took a knock when it comes to the entire fintech space. There are regulations coming on small cap, mid caps, and then there are probably regulations coming in on hospitals as well, with that standardization of pricing of some of the procedures. Do you think really that is something that could be employed and deployed by the government? And if yes, it would be a very sharp hit to the profitability of all these hospital companies, right?
Actually, I don't think so. I think it's the opposite. Hospitals will therefore gravitate towards that price and not try to optimize and reduce prices. This is an unfortunate consequence of trying to rein in prices, is you cannot bring those prices down significantly from there. I'll give you an example. Stents. When the government introduced the law that stents you cannot charge more than X amount for stents. Did the cost of stenting procedure go down? Initially it did, but now there is almost no incentive to improve cardiac stents or other stents as well. The pricing of them meaningfully, because the government set up the max price, and that's why you're going to go. I don't think this is going to be progressive from that perspective, for us, of course, I'm not the expert, but I'm looking at from the economics part of it. If you set pricing as maximum, that becomes the minimum price. Once the Pakistan Stock Exchange said prices can't go down, for 45 days prices didn't go up. Also, they stayed at this exact same price. So setting up these minimums and all that stuff stifles the need to actually bring prices down. So we might have a counter impact of some of these. I understand the sentiment behind it, but I think control is not the answer. It may be a procedure that says control for a while prices are high, but eventually let it go. It will eventually result in better numbers. And what's to say tomorrow that inflation does not come in and say 5% inflation? In about 5 or 6 years, you're talking about 30 to 40% higher prices. Nobody will be able to do this, run a hospital business, if you had max prices on everything.
How are your latest additions to your funds looking like? Which areas have you nibbling in, you've been reading and researching about, or would buy on declines from here?
So actually, interestingly, we'd like to buy both on. I like to buy more when the stocks go up rather than just on declines. But we're still very positive on a few themes that are very specifically India because of the infrastructure changes, because of the focus on a lot of Indian local domestic improvements. We're adding more players in logistics, for instance, that allows us to kind of participate more or see the urban and rural consumption divide kind of narrowing down over a period of time simply because of accessibility, roads, rail, and cargo infrastructure. We're also adding a few players. I mean, we've added we have very little changes from last time, but I think what we've done is we've added a couple of special situations where, again, Indian manufacturing spaces where we're targeting some of the MNCs in India are trying to exit their portfolios, so that's not a good sign, or rather reduce their promoter holding. But there are others where, because of a change of management, they're going to have to give open offers at higher prices. So some of the new additions have been special situations for more shorter terms there. But I'm still focusing on a few themes that we've focused on for the last 2 years: domestic consumption, financialization of the economy, including investment technology companies in the space, and import substitution through local manufacturing. So I think that is something that we're from semiconductors to a bunch of players around infrastructures, around domestic manufacturing, auto ancillaries. We've continued to add those names. I haven't honestly changed the portfolio too much. Some of the small caps have become mid caps, thankfully, but that's the only, the mix has changed from what was a small cap plus large cap portfolio to more small plus mid plus large.
Taken, but since you're talking about consumption, actually let me bring on the conversation that we have with the management of V2 Retail, because that's a conversation I think my colleague had with the management in terms of how the retail space is doing. I'm sorry, was it V-Mart or V2 Retail? I'm a bit confused, but let's go across to my colleague Aishwarya, who's joining us with the conversation with V-Mart Retail's management.
What is good, what is undiscovered, what is valuable always gets more attention and always gets more and more player. And there is definitely mammoth business out there in the value retail space, in the value fashion retail space. Because in India, with 130 crore of population, almost 85% of the population is someone who only can afford value and are a great propagator of value. And when that Bharat consumes, and they want to consume in the right environment, they want to consume with the right product, they want to consume with the right value and for the right product quality.
The average basket size in tier 2 cities would be definitely different from a metro city. From that perspective, if you could talk, has that grown? Have you seen any sort of incremental growth there?
No, I mean, definitely, at what period are we looking at this? Definitely the smaller town, which is the tier 2, tier 3 towns. We have also got a survey now and already released by the Niti Aayog, and so there is definitely a lot that the tier 2, tier 3 towns has grown. But still, compared to a metro or compared to a tier 1, definitely the basket size is lower. The average selling price of the products are lower, and the potentiality for the customer to buy at a time for a large value is much more lower than what a metro would do. So there is our average basket size is around 800, and that's what I think is sweet spot for the tier 3 towns. But in certain tier 1 towns, we also see basket size up to 1,500 rupees.
So in terms of the next year, 2024, I mean the rest of the year for 2024, any sort of guidance in terms of expansion, store expansion, same store sales growth, if you could give us a sense of that.
No, I think we believe in India's story, we believe in Bharat's story, and we believe there is more potential. There is a lot of towns and cities where we are yet to go. There are a lot of towns and cities where we have 1 store or 2 store, we can penetrate and grow more.
Okay, so that's a conversation with V-Mart Retail. But Deepak, what's your view on this entire SEBI coming down on the flows into mid-cap and small-cap? Has been making a lot of rounds, making a few, ruffling a few feathers, making a few people nervous. What's your take?
So I think intention is good, obviously. See, they've seen what happened at Franklin when the underlying market gets very illiquid. Then some people who have advanced information of the markets becoming illiquid will exit their investments ahead of everybody else, and then other people suffer. They've addressed it with something called swing pricing, where when the market becomes illiquid, you give a lower NAV to a person who's exiting now, simply because you know that exiting will cause the prices of everything else to fall, and therefore the illiquidity discount in a way is up to 1 or 2%. I think 2% is the maximum you can give as a discount, and that to above 2 lakh rupees. Now, they don't have such a structure for equity funds. We also know that small caps have gone up quite a bit. I think that's fear of this gone up quite a bit is just that they've done 50% in the last year or something. To be fair, from 2019 to now, they have grown their earnings 3x, and they have also seen prices go up 3x. So it is not like the earnings are very different from 2019, but today sounds like a little bit of a scary enterprise. But here is where the problem comes. If you attempt to you cannot, for instance, gate exits. You cannot say that you can't exit. You have to provide everyday exits in open-ended funds. The best thing you can do is stop fresh entries, or tell them that you can't invest more than, say, 10,000 or 20,000 rupees in an SIP mode. That a lot of funds have also done. But there's still the 5th largest fund in India is by AUM, active fund by AUM, is a small cap fund. The largest fund in India by AUM, actively managed, non-ETF, non-index fund, is a mid-cap fund. So you end up with large amounts of AUM following in these companies. If you look at small caps, the definition of small caps is between 7,000 and 21,000 crores. As of, I think, July to December 2023, the classification wise. So if you have a company whose average market cap is 15,000 crores, and you buy 1% of it, that's a very large number for a mutual fund to buy. That means you have a 150 crore exposure. Now, the largest small cap fund has 45,000 crores in it. That 45,000 crores will have, let's say, 65% of small caps, which is roughly about 30,000 crores. Now, they have to buy 200 companies with 150 crores each, owning 1% of each company, in order to make up that 65%. So they have a well spread out, mostly well spread out kind of investing footprint. And okay, a few of them will have lower circuits for a while. That's fine. I don't think all 200 small cap stocks will end up having circuits all the time. Some circuits will be there. Some stocks will be difficult to exit in case of a downturn. So what mutual funds should do is obviously create buffers by having 20 to 30, 35%, up to 35% you can have it as more liquid instruments. Could be large cap stocks, could be government securities, could be something more akin to cash. But I think that still is possible to do by small cap and mid cap funds, is to keep these buffers. However, I still don't feel they'll help, because no matter what happens, when a market goes down, there is illiquidity, there will be fear. And without swing pricing, the remaining investors will always suffer. So they will, I think this is a good intention, but the sources of what funds can do are very limited. because they cannot be allowed to tell people that they cannot exit. If I put an exit order today, within 3 days,
Sure.
I need to get money. Yeah.
Okay, no, that's